So today I'm going to discuss Australia's evolving external position and the development of foreign exchange markets. I'm going to emphasise the growing footprint of superannuation funds in Australia's capital flows and the importance of these and other buy-side firms of adopting best practices in FX markets. Just work through the feedback a bit. I'll start with Australia's capital account and a bit of a history there, as well as FX markets, starting back with the float. So the removal of capital controls, capital account restrictions, the floating of the Australian dollar in 1983 really reshaped our economy. Free capital movement facilitated very large increases in foreign investment in Australia, and it allowed Australian households and firms to diversify their very own portfolios by investing those overseas in a way that they couldn't do so before. And deep, well-functioning FX markets that developed following the float, those helped banks, businesses and fund managers to help manage their foreign exposures. Australia's integration into global capital markets saw two distinct trends in terms of our net investment position with the rest of the world, which are shown here. So first, in the decade after the float and beyond, Australia's high investment rate at the time was associated with rising foreign debt, as you can see here. And this saw net foreign liabilities rise substantially to around 50% of GDP. And then the second phase, over more recent times, saw outbound investment grow as a share of GDP as Australia's savings rate rose and domestic investment declined. This accumulation of foreign assets has contributed to an extraordinary decline in Australia's net foreign liabilities, and it's now back at levels that we saw just prior to the float in 1983. Now, while foreign ownership of Australian assets was already common, at least in some sectors, the full opening of the capital account in 1983 allowed for much more foreign investment in Australia. The growth in debt held by overseas creditors was particularly noticeable in banking as well as resource sectors. That increase in cross-border investment was accompanied by a rise in FX transactions. Prior to the float, spot transactions by local commercial banks, they were the dominant form of FX transaction. While the Australian dollar spot market grew pretty strongly, the 1980s also saw the establishment of FX swap markets. And these instruments, which allowed market participants to better hedge their foreign currency exposures, quickly became the most traded in Australian dollar markets. The deepening of FX markets locally was also supported by Australian government steps to broaden foreign banks' participation in Australia's markets. The growth of those currency markets, that enabled non-financial corporations to make the use of hedges in support of their trade flows and their foreign currency borrowing. And this hedging occurred in part in response to post-float currency volatility and some very high-profile losses by unhedged borrowers in the 1980s. So over the 1980s, both the share of firms hedging and the average share of the currency exposures that they hedged, that increased significantly. By about the mid-1990s, the internationalisation of the Australian dollar and its capital markets was pretty well advanced. Trading in Australian dollar FX derivatives had risen to about $75 billion per day, and about 60% of that was actually undertaken offshore. Also, foreign entities were issuing debt in Australian dollars in the so-called kangaroo bond market. And that issuance grew steadily over the 2000s, supported by cross-currency basis swaps, another FX derivative, but with somewhat longer tenors, and that enabled better hedging of long-lived foreign currency borrowing. Rising demand for Australian dollar assets from international investors enabled Australian businesses themselves to issue debt in Australian dollars. And at the same time, Australian banks and businesses issuing in large offshore markets could hedge their foreign currency denominated debt back into Australian dollars at a modest cost. And it's important to recognise, perhaps not so well appreciated now, because we take it for granted, but these developments greatly reduced the vulnerability of Australian debtors to an Australian dollar depreciation. If we think about it, the growth in Australian dollar FX markets since the float has really been quite remarkable. So the Aussie dollar is now the 6th most traded currency, even though Australia ranks just 13th in terms of economic size. I think what that demonstrates is the importance to Australia of FX markets in support of foreign trade and investment. I think there's another angle at work here. It also reflects the attractive correlations of the Australian economy and hence the Aussie dollar with economic developments in Asia, and couple that with strong institutional settings in Australia, including the free movement of capital. I think that's one of the reasons why the Aussie dollar is so heavily traded. Another key facet of Australia's external position has been the substantial growth of net foreign equity. The net foreign equity position, and you can see that in this chart. So Australians have steadily accumulated more foreign equity holdings, so that's shown in the dark line on the left, than foreigners have accumulated in Australian equity, shown in the red line on the left. And so the net of those two things, since 2013, we can see we've had a positive net equity asset position. The rise in net equity assets of late has occurred while Australia has been running a current account deficit, and that's actually a somewhat unusual situation. So we've had inflows of new liabilities. They rose with the banks returning back to offshore debt markets as the RBA's term funding facility came to an end. However, a further rise in foreign equity holdings offset that, and so net liabilities have still declined. Much of the rise in net foreign liability equities reflects valuation effects from the Australian dollar's depreciation, but also from rising overseas equity values, and you can see that in this chart. Even so, new equity accumulation continues, driven by investment from Australia's superannuation funds. The growth of superannuation funds since 1993 and their rising offshore investments have significantly shaped Australia's balance of payments. Super funds offshore asset allocation has increased from nearly 1/3 in about 2013 to about half in 2024. And as a result, super funds now account for a very substantial share of Australia's capital outflows. Purchases of foreign currency assets by super funds expose them to exchange rate fluctuations, and many funds shield their members by partially hedging the foreign exchange risk associated with owning offshore assets, for example, via FX swaps. And given the large increase in super funds' offshore assets, the extent of foreign currency assets hedged has more than quadrupled since about 2013. So what that means is it's made them, the super funds, natural counterparties to domestic banks who are going the other way. They're hedging their FX exposures arising from issuing debt offshore in foreign currency terms, say in US dollars out of New York. So I want to turn with a few remarks about the Foreign Exchange Global Code, but Stuart, who'll follow me, will have a lot more to say about that. I think what my discussion shows and highlights is the increasing role of super funds and their asset managers in FX markets. Now, for FX markets to meet participants' needs, it's important all participants observe common standards promoting fair and transparent markets. And the Foreign Exchange Global Code, or just the code, as we like to call it, fulfills that function. With the advent of the code in 2017, buy-side participants like super funds could have greater confidence in market functioning and the behaviour of their sell-side counterparties. But it's important to recognise this is a two-way street. So both sell-side and buy-side firms should adhere to the code's standards. I think the other thing maybe not fully appreciated is one way for fund managers to demonstrate that they're meeting their fiduciary duties is to adhere to the code. So encouraging more buy-side participants to sign up is a focus of the Global Foreign Exchange Committee. To this end, the GFXC has worked hard to explain the process of signing up to the code. We've emphasised that adoptees can concentrate on those aspects of the code that are material to their activities. And that greatly reduces the burden for buy-side firms who might not need to otherwise sign up to all elements of the code. Let me just end by acknowledging the very sharp rise in volatility in FX markets in early April, as markets incorporated announcements about the US administration's tariffs and then the subsequent ebb and flow of related news. The Australian dollar fluctuated within a range of about 4 US cents, experiencing its largest daily decline of 4.5% against the US dollar, at least outside of the GFC. Also, measures of volatility from FX options increased to levels observed during the pandemic, and liquidity deteriorated noticeably. So, while markets have been more settled of late, such episodes do serve as a reminder of the importance of the code. What the code does is it enhances trust between market participants. It offers standardised and predictable ways of doing business. So, for that reason, the role the code plays in proper market functioning is even more crucial during periods of great uncertainty when markets are adjusting to significant economic news as they have done of late. So let me finish there, and I think we'll take a few questions from the floor.
Chris, thanks very much for your remarks. Phil O'Donoghue from Deutsche Bank. You noted the superannuation funds buying a lot of offshore assets. In the details, that is mostly equities. Are you starting to see some fixed income buying from the super funds, or an increase in fixed income? And do you expect that we're going to see that? If you look at the Aussie super funds, we're heavily exposed relative to other pension funds around the world to equities. Do you think that will shift as the structure of those assets changes over time?
That's a good question, Phil. I don't know the answer to it. I mean, I would expect that as part of a balanced portfolio, they should be exploring that like other assets. The extent that they have, though, I'm not sure. Maybe some of our panellists later on can come back to that one, but it's a good question.
Thank you. Thanks, Chris.
Thanks, Chris, for that. Just on the point that you make about the increasing hedge books that the superannuation funds are running as they continue to accumulate overseas assets. The last two financial stability reports from the RBA seem to be bit of highlighting or expressing some concerns about the size of those hedge books. And could you just expand a little bit about where the sort of, from a regulatory point of view, where the RBA's concerns really lie?
No, it's a good question. This is really joint concerns amongst members of the CFR and particularly APRA, who are the regulators of the super funds. I think the issue isn't so much the hedges, but that hedges imply one way or another that the super funds need to be able to provide liquidity at critical times when markets are moving a lot and their position might move against them in a way that they have to front up with some cash, either when they're rolling their positions or for margins and the like. So it's more about just sensible liquidity management. And I think the concern is that at least potentially, if all super funds are rushing for a bit of liquidity at the same time, what secondary effects might that have on other markets? So the hedges in a way are a stabilising mechanism, but the response to volatility when you have a lot of hedges in place might cause some volatility and knock-on effects in other markets.
All right.
Okay.
Thanks again, Chris.
No, thank you all. Thanks for listening. And